hour, let's get back to our question of the day. Are we heading for a Minsky moment? Joining us now is Marvin Barth, Thematic Markets founder. He held senior roles at the Federal Reserve and the US Treasury Department. I have to say, if you're looking for a harbinger for the end of the world, it's that Marvin is no longer wearing a bow tie. Just going to point that one out. Nice to see you.
Pleasure seeing you, Guy.
A Minsky moment. The issue was raised by Mark Economic over at JP Morgan yesterday.
Yeah.
How high do you see the risk of such a disorderly event taking place?
I actually think it's not particularly high, and certainly not in the U.S. If you look, the U.S. recovery seems to be incredibly broad. If you look at employment growth across the country, across industries, it's much more robust this cycle than it has been in previous cycles. We're seeing a significant stability of growth across the board there. What we've seen is some of the aspects of 10 years of quantitative easing explicitly encouraging banks to take a bunch of interest rate risk, and then shocked, that they actually had interest rate losses as a result of it when you hike rates. Now, I think the Fed, through its term lending program, has taken care of that. I think the real problems are actually where we haven't seen action, which is in Europe. So I'm not particularly concerned.
Marvin, hey, it's Alex in New York. So, I mean, why? Because you could also make an argument that shadow lending and shadow banks, that number has just ballooned and that's the real risk here in the U.S.
Yes, but that shadow lending, unlike back in 2008, where it had a direct tie into the banking sector, off balance sheet, you don't have that same sort of situation now. Actually, that shadow lending is being taken place by fixed capital that was invested in these alternative lenders. That doesn't blow up as easy, Alex. So I'm not as concerned about that. I am much more concerned about the fact that all of the policies of the last decade in Europe, as we saw with Credit Suisse, were actually much more focused on not encouraging banks to take interest rate risk, but to take more credit risk.
The Europeans rely on that, though, don't they? Because
yes.
that's how the system works.
Their banking system is much more pervasive in the economy. The U.S. economy is much more securities-based. That's part of why you saw this difference there. But of course, credit risk is much harder to observe than interest rate risk, right?
So the ECB should stop and the Fed should keep going?
I think so.
What do you think is going to make the Fed? What will make the ECB do that? Like, what will we see that will then implode that will make them do that?
Well, I think, all central banks right now are having to deal with the fact that inflation is much stickier than they anticipated. I think that's something that they're going to continue to have to deal with. It's something we saw in the U.S. CPI data last week, and it's clearly what the ECB was thinking about recently when they went ahead and hiked amid all this turmoil. So what's going to cause them? You're going to actually have to see much more significant slowing in the economy. You are going to have to see troubles at European institutions, not Swiss European institutions, but Euro area institutions. That's the type of thing that's going to cause them to pause.
Doesn't the European economy have the lifeboat of the Chinese economy? And that is going to provide it with a much stronger foundation in terms of the demand story that drives economies like Germany. Aren't we in a better position here in Europe than over in the United States in terms of just where demand is going to come from?
So I think one of the big themes that's been driving the global economy is localization, i.e. that what we're seeing is not globalization and not deglobalization, but localization. When a machine with AI can do your job cheaper than the cheapest worker anywhere in the world, why would you have an outsourced supply chain? That's entirely what Europe was dependent on. And if we look at the pre-COVID cycle, Europe massively underperformed despite China doing okay. China's not doing okay right now. Yes, they're doing better than they were during COVID, but I do not have the same sort of faith that actually Europe can rely on China as a growth engine. I think what you're seeing in the U.S. is much more exciting. You're seeing really significant capex taking place because of localization, because it is all coming back. Not because of trade policy, not because of politics, but because it's cheaper.
But Marvin, is part of that cheapness the IRA and the infrastructure bill, in which case Europe's been trying to follow suit in that as well?
Yeah. So the interesting thing about this is if you look at this localization trend, Alex, and where it starts, it actually starts back in 2012. Before anyone started talking about trade, you really start to see CapEx pick up in the US. It was really driven by technology, and it's a private sector initiative. This is something that is a fundamental economic phenomenon. It's not a policy phenomenon. That's one of the reasons why I believe it's so strong, and that's one of the reasons why I'm so much more confident in the US economy right now and why it is so much more diverse in its growth.
What do I want to buy? What do I want to sell?
Okay, so right now, I think markets have massively overestimated the potential for the U.S. economy to slow and for the Fed to start cutting rates. And so one-year rates have fallen far too much in the U.S. On the converse side, as I said, I actually don't think Europe can handle that much more. And so it was already the case where I thought you should be paying U.S. rates on a one-year basis and receiving on a European basis. This has just opened that up even more. As we're seeing in the bounce in banking stocks today, I think people underestimated or rather overestimated the issues with U.S. regional banks. The Fed term lending program is really going to help them out. There's real opportunities there. And as a result, I think they actually provide a better opportunity going forward relative to some of the GSIBs.
So you like U.S. regionals right now? Am I getting that right?
I think they... Yes, I'm suggesting that when you look at their problems, right, their problems were that they have a lot of hold to maturity securities that they face losses on if they have depositor flight. But they can now deposit those at par with the Federal Reserve, get liquidity to meet those things. And if you just hold them to maturity, there's no losses on them whatsoever. There's no losses there.
Do we get a tightening of lending standards in the United States as a result of what is happening, and how severe will that be?
Well, that already had started to happen, right? You can see that in the senior loan officer survey.
Yep.
There was significant tightening even before this. Now, we're still getting a solid CapEx cycle in the U.S., so it was definitely slowing things down, but there's still strong demand in the background. This is going to slow it a little bit more, but ultimately, all these regional banks are going to stop and look and say, well, wait a second. I'm not going to take losses on my portfolio. Things are okay. And yes, they're going to be nervous about regulators looking over their shoulder for the next few months, but then they're going to look and say, actually, my balance sheet is okay. I can go out and lend. And remember, to grow out of this, they need to lend.
Yep.
What do you hate right now? Like in that environment, I know everyone's worried about commercial real estate, for example. Where are you totally going to stay away from?
Well, look, I think, Alex, this goes back to this point I made about localization, and this is the big theme that people are missing. Anything that was tied to dependence on low or negative real interest rates, those entities are under pressure right now. That's why crypto and everything blew up first, because that was fantasy earnings that needed negative rates. The same thing, anything that is tied to globalization, anything that needs negative real interest rates to go on, those are the things that are going to be a problem. And so credit offers an amazing alpha opportunity this year. We're going to see exactly this. Entities like that will blow up, but other entities that are leveraging localization are actually going to outperform. So as on the whole, credit may, I don't know, perform any which way relative to other asset classes. But from an alpha perspective, picking winners and losers, you have much better opportunities there.
Just to wrap this up, so from what I'm hearing, you think the Fed should go 25 tomorrow, yeah?
So I think they should. But I called them completely wrong in 2019, so I'll admit it.
What signal should they send tomorrow?
I think that the right signal is exactly what Jason Furman is saying. It's exactly what Bill Dudley is saying, that they have faith in the system and that indeed they are going to focus on the inflationary pressures they're facing. The U.S. economy's overall health is robust, and they should hike 25 basis points.
Marvin, so great. Really good to get your perspective. Really appreciated, Marvin Barth, Thematic Markets founder. Thank you very much for joining. All right, coming up, former Morgan Stanley